The bank just approved you for a $400,000 mortgage. Your real estate agent is sending listings. Your parents are asking when you are finally going to stop throwing money away on rent. And you are sitting on Zillow at midnight, staring at a house with carpet the color of quiet desperation, wondering why everything feels wrong. Here's what nobody in that entire process will tell you. The bank's approval number and the number you can actually afford are two completely different numbers. And every person involved in selling you that house has a financial reason to make sure you never figure out the difference. Today, we are doing the math nobody does for you. Let's go. The gap that changes everything. There's a rule called the 28% rule. Your total housing costs should not exceed 28% of your gross monthly income. Mortgage, taxes, insurance, everything combined. The bank uses a different standard. They approve you as long as all your debts combined stay under 43% of gross income. Housing, plus car payments, plus student loans, plus credit cards. These are not the same thing, and they do not serve the same purpose. The 28% rule protects your quality of life. The 43% threshold protects the bank's loan. The bank does not care if you are miserable. They care that you keep making minimum payments for 30 years without defaulting. That 43% number is not a recommendation. It is the maximum financial stress they believe you can absorb before you simply stop paying. The gap between those two numbers is where people accidentally destroy their finances while feeling responsible about it. What a $400,000 house actually costs. Most people calculate their housing cost as the mortgage payment. This is the most expensive mistake in personal finance. 10% down on a $400,000 house leaves you with a $360,000 loan at 6%. Principal and interest payment is approximately $2,150 monthly. Now add the real costs. Property taxes, depending on your state, run $300 to $600 monthly. Call it $450. Homeowners insurance has risen 48% nationally since 2020. Budget $300. Because you put less than 20% down, you owe private mortgage insurance, another $275 monthly for not being wealthy enough to avoid it. Maintenance at 1% of home value annually is $333 per month, and that assumes nothing major breaks. Your real monthly housing cost is $3,508, not $2,150. To keep that under the 28% guideline, you need to earn approximately $150,000 annually. The bank would approve you at $98,000. $52,000 gap. That gap is the difference between homeownership and being house poor. What being house poor actually looks like. A household earning $80,000, roughly the national median, buys that $400,000 house. The bank approved them. They move in feeling like they finally made it. After taxes, their $80,000 becomes approximately $4,600 monthly in take-home pay. Housing consumes $3,191 of that, leaving $1,400 for everything else. Groceries, utilities, car payment, insurance, gas, health insurance premiums. Those alone exceed $1,500 monthly in most households. They are underwater before buying a single item of clothing or saving a single dollar. Every unexpected expense becomes a crisis. The car needs brakes, credit card. The HVAC dies in July, financed at 22%. This is not stability. This is home ownership consuming every dollar that used to provide stability. The bank said they could afford it. The math says they absolutely cannot. Why your parents keep telling you to just buy. Your parents bought a house at your age. They keep mentioning it. What they genuinely do not understand is that they bought in a completely different economic reality. In 1980, the median home price was 3 times the median household income. Today, it is 5 times. They were buying houses that cost 3 years of salary. You are being asked to buy houses that cost 5. Yes, they had mortgage rates above 13%. Monthly payments were brutal, but the purchase price was reachable. They could save a down payment in a few years, not a decade. And when rates dropped, they refinanced. You cannot refinance the purchase price. College cost $738 per year in 1980. The average new car payment was $153. They bought houses on single incomes because that was financially viable. Today, most households need two incomes just to qualify and are still stretched. The median age of a first-time buyer has risen from 28 in 1991 to 40 in 2025. Your parents are not lying. They're describing a world that no longer exists. The hidden costs nobody mentions until after you sign. Recent research puts average hidden annual home ownership costs at $21,400. That's nearly $1,800 extra monthly that the listing description never mentioned. Water heaters die every 10 to 12 years. Roofs fail every 20 to 25 years. Costs range from $10,000 to $30,000. HVAC systems last 15 to 20 years. When yours fails in July, you're looking at $5,000 to $12,000 for replacement. These are not if scenarios, they are when scenarios. Every house will need all of these. The only question is timing. And homeowners insurance has become its own financial crisis. Premiums are up 48% nationally since 2020. In some states, people are paying over $1,000 monthly just for insurance. Climate change is not a future concern for your housing budget. It is a current line item growing 8% annually. Property taxes never stop and never meaningfully decrease. In some states, that's over $9,000 annually on a median-priced home, every year, forever. The down payment treadmill. 20% down on a $415,000 house is $83,000. The median household saves approximately $4,000 annually after expenses. At that rate, saving $83,000 takes over 20 years. Even aggressive saving of $1,000 monthly takes nearly 7 years. Meanwhile, home prices appreciate 3 to 5% annually. The target keeps moving. You're trying to catch a bus that is accelerating away from you. This is not a discipline problem. This is arithmetic. Will a crash fix this? No. The honest answer is no. 81% of existing mortgage holders have rates below 6%. 21% have rates below 3%. These people are not selling. If they sell, they must buy another house at current prices with a 6% mortgage, so they stay. Inventory stays low, low inventory keeps prices elevated. It's a self-reinforcing loop with no obvious exit. Here is something that should completely reframe how you think about renting. In all 50 of the largest U.S. metros, renting is currently cheaper than buying. Every single one. The average mortgage payment exceeds average rent by 38% nationally. If you are renting and feeling like you are throwing money away, you are currently making the mathematically correct choice in most markets. What you can actually do. 4 real options. None of them involve buying a house the math does not support. Move somewhere the numbers work. The same salary that barely qualifies you for a mediocre house in a coastal city buys a genuinely comfortable life in Pittsburgh, Cleveland, Columbus, or Atlanta. Geographic arbitrage is not giving up. It is doing math. Buy significantly less house than you think you want, not the house that photographs well, the house that fits comfortably inside your real budget. Longer commute, smaller square footage, financial stability. House hack. Buy a duplex, live in one unit, rent the other. Rental income can cover 50 to 100% of your mortgage. Not glamorous, effective. Wait. Keep renting. Save aggressively. Let your income grow. There is no prize for buying a house you cannot afford. There is no shame in recognizing the math does not work yet. The bottom line, you are not failing at home ownership. Home prices have outpaced wages so dramatically that what was a normal middle-class milestone for previous generations is now a luxury purchase requiring top 10% income for a slightly above-average house. The bank will tell you that you are approved. The real estate agent will tell you this is just how it is. Your parents will tell you to stop overthinking it. None of them are running your actual monthly budget after taxes, maintenance, insurance, property taxes, and PMI. Now you have those numbers. Run them against your income and your market. If the math genuinely works, buy the house. If it does not, you have just made the most valuable financial decision available to you, which is recognizing a bad deal before signing 30 years of your life to it. The bank approves loans. It does not approve your quality of life. Only the math does that.